In early June 2026, Bitcoin plummeted below $60,000. People panicked and sold up. It seemed like the crypto dream was dead. But while retail investors were losing their life savings, Wall Street was executing the largest wealth transfer of the decade. Because this wasn't a crash, it was a robbery. A deliberate move designed to flush out over $1.8 billion in leverage. Friday, June 5th was one of the most dramatic days the crypto markets had seen in years. It happened so fast that most traders barely knew what was going on. Bitcoin, the premier cryptocurrency, which had been trading above 80,000 only a few weeks prior, experienced a sudden, colossal collapse. Millions of cell phones vibrated simultaneously across the world as the news came in. BTC's value was taking a nosedive. It even dipped below the $60,000 mark to reach a $59,100 intraday low at one stage. It managed a minor recovery, hitting $61,000 the next morning. But it was chaos, a market failure, at least to the untrained eye. It seemed like the definitive piece of proof that critics of the crypto world had been waiting for, a clear sign that Bitcoin and crypto in general can't be considered a safe and secure store of value. But here's the truth. This wasn't a failure or uncontrollable crash. It was a controlled burn. A burn that was perfectly executed, mathematically precise, and absolutely necessary for the market to not just recover, but to reach whole new heights. It was the financial equivalent of setting fire to a diseased forest so that healthier roots can take hold. Because while most people were focused on the price charts, they were only seeing the smoke. The real fire was happening behind the scenes. Approximately $1.8 to $2.5 billion worth of toxic leverage was utterly incinerated. Here's why that matters. Leverage is like a plague on the financial system. It's borrowed funds. It's retail traders effectively betting with money that isn't theirs. That in turn forces the system into shaky ground. The more the leverage builds up, the more unstable the situation becomes. Eventually, it reaches a point where the market can no longer move, grow, or progress until that leverage is wiped out. In other words, for Bitcoin to take the next step in its evolution, for this crypto rocket to surge, the leverage had to be jettisoned. But that money can't just vanish, it has to go somewhere. While terrified users were frantically smashing the sell button as they feared the worst, the entities buying up their assets weren't amateurs or casual investors, they were pros. Wall Street investors who took advantage of the fire sale, snapping up assets at a massively discounted rate. They were confident that they would double or even triple their money on the other side. The retail market provided exactly what the big dogs of the investment world had been waiting for: exit liquidity. Everyday investors became fuel for the machine. They thought that they were fleeing a sinking ship. In reality, they were handing over their hard-earned portfolios to giant investment firms. But this crash didn't start in the crypto markets. It started in Silicon Valley. Money is the oxygen of the market. When it flows in, assets grow stronger and more valuable. When it leaves, they become weaker. And in the weeks and months building up to June 2026, one sector in particular was sucking up almost all the oxygen available. That sector was artificial intelligence. In just a few years, AI has infiltrated almost every aspect of modern life. It's become one of the most powerful technological forces on the planet. And where there's power, there's value. Investors didn't want to miss out on making the most of that value. They had to get in on the ground floor of the biggest and best AI companies, as well as emerging up-and-comers, to maximize their long-term gains. 2026 has seen numerous big AI brands making their entry into the markets, with a swath of highly anticipated initial public offerings, or IPOs, arriving on the scene. These are the companies of the future, the masters of machine learning, the creators of the next generation AI models. And unsurprisingly, they attracted a lot of attention. The valuations for some of these companies were almost unprecedented. An unstoppable wave of hype built up and only got bigger as IPO after IPO hit the stock market. The global financial ecosystem responded instantly. Hedge funds and venture capital firms suddenly found themselves in a race against the clock. Some of the biggest tech listings in years were about to hit the market, and everyone wanted a piece of them. But they needed cash fast. You might think that they would start unloading stocks or selling off parts of their real estate portfolios. They didn't. Instead, many turned to the fastest source of liquidity they had available: cryptocurrencies. Slowly but surely, they began draining liquidity out of the crypto markets to pour into AI IPOs. It happened in the background, and bit by bit, the depth of Bitcoin order books began to thin out. The total volume of cash in the world's leading cryptocurrency slowly but surely evaporated. On the surface, the market seemed to be performing as normal. Deep down, however, its foundations were being ripped out. A system with high liquidity can cope with a crisis. But with liquidity drained, the crypto market was a dry forest just waiting for a match to set it all ablaze. And the algorithms knew exactly where to strike. There's a rhythm to financial markets that most people don't understand. They believe that a healthy market should only ever move in one direction, up. Volatility is seen as a weakness, a defect. The best and most successful investors see things very differently. They understand the rhythm of the markets, the cycles, the rises and the falls. They know that volatility is a feature, a necessity even. For any asset class to mature and reach its full potential, it has to pass through periods of structural collapse. It's only by falling that markets learn to rise even higher. The evidence is right there in the data. Not in the price charts that everyone watches, and not in the surface-level metrics that most retail investors obsess over. It is in the deeper macro-level indicators, the kind the world's most sophisticated trading desks use to plan their orders and time their trades to perfection. One of the most powerful is something called the Market Value to Realized Value Z-Score, or MVRV Z-Score. It sounds complicated, and in many ways it is. Think of the MVRV Z-Score as a market alarm system. When it flashes red, Bitcoin might be trading above its fair value. When it moves to the opposite extreme, Bitcoin might be massively undervalued. Take a look at how the Z-Score has fluctuated over time, and an astonishing trend emerges. During all of the past big Bitcoin crashes, 2015, 2018, and 2022, the Z-Score always did the exact same thing. It dropped below zero, plunging into negative territory. Every time that happened, the media started writing headlines and publishing reports about how Bitcoin was too volatile and dangerous for people to invest in. Some even called the cryptocurrency market dead in the water. Meanwhile, the smallest investors ignored the noise and focused on what mattered, the Z-Score. It was a flashing red light and screaming a single all-important order: buy. Because every time that score dropped below zero, Bitcoin rose by at least 300% in the cycle that followed. It's a pattern that's played out over and over. In March 2020, the global pandemic ground the world's economy to a halt. Bitcoin's price was slashed in half within just a couple days. The panic was palpable. But in the 180 days following the massive decline, the long-term holder supply, the total volume of Bitcoin owned by entities that refused to sell, increased by approximately 3 to 5 percentage points. That's the equivalent of taking the entire gold reserves of America off of the open market and moving them to a private vault within 6 months. It was a silent yet massive consolidation of wealth, a dramatic shift of Bitcoin out of weak hands into strong ones. This is a biological necessity of a healthy market. It needs to fail so that it can be reset and rebuilt better than before. And this too is something that we've seen happen in the past with devastating precision. In 2021, Bitcoin was performing well. It reached an all-time high in the $60,000 range by the spring, when suddenly a barrage of bad news sent its value plummeting yet again. Prospective mining bans, regulatory measures, and forced liquidations all took their toll. Within just a few weeks, Bitcoin's price had been slashed in half, sitting in the low 30,000s. The same narrative emerged again. Bitcoin was over. The bull market was dead. Anyone still holding crypto better get out while they can or suffer even greater losses. Large parts of the retail public followed that advice. They sold off their assets and rued the fact that they hadn't got out sooner. But the smartest investors saw what was really happening, a unique phenomenon known as the Wyckoff accumulation phase. Named after a legendary investor, editor, and founder of the magazine of Wall Street, it describes a strategy that many believe the largest market participants have used for decades. Before major moves to higher prices, the biggest players don't usually buy all at once. Instead, they accumulate. The so-called whales do this to frighten retail investors to the point that they sell off their holdings. During the 2021 Wyckoff phase, however, an uneasy anomaly appeared. The number of whale wallets, those holding 1,000 BTC or more, started to decline by around 12%. At the same time, the number of smaller retail-level wallets increased as casual investors bought into the dips in the hopes of turning a quick profit. The narrative shifted to something even scarier. Big money was backing out of Bitcoin. The public once again bought into this story, but the whales weren't really abandoning Bitcoin, they were preparing for a massive leverage wipeout. On May 19, 2021, that wipeout arrived. A staggering $8.6 billion was wiped out within a matter of hours. To understand the magnitude of that value, $8.6 billion is enough to purchase the Dallas Cowboys, one of the world's biggest sporting institutions, outright, and still have $3 billion to spare. The impact was immediate. Retail accounts were liquidated to nothing. This in turn set up the largest wealth consolidation since the 2008 financial crisis. By the end of 2021, Bitcoin's value had surged yet again. Now in 2026, there's enough data to show that this isn't random or coincidental. History is repeating itself with surgical precision. The June 2026 crash is almost a mirror image of the 2021 event. The same headlines, the same narrative, and the same emotional impact on the retail investor market. But 2026 has a safety net that 2021 never had, a floor built by the most powerful financial institutions on Earth. In early 2024, the rules of the Bitcoin market were effectively rewritten. The United States Securities and Exchange Commission officially approved the first Bitcoin exchange-traded funds, or ETFs. For more than a decade, Bitcoin had existed as a separate entity from the global financial system. It was always on the fringes, volatile, lacking in regulatory oversight, and difficult to break into for both amateur investors and even traditional institutions. The launch of the exchange-traded funds, or ETFs, changed all that. It bridged the gap that had separated Bitcoin and the legacy financial system for so long. The impact was immediate. The titans of the investment world like BlackRock and Fidelity jumped into the pool headfirst. By the end of the year, they had held a jaw-dropping 900,000 BTC in their institutional vaults. That's around 4.6% of the entire circulating supply of the asset itself. To put the number into perspective, 900,000 Bitcoin is just 200,000 Bitcoin short of the total of the 1.1 million lost coins of Satoshi Nakamoto, the pseudonymous creator of Bitcoin, worth roughly $80 billion. It's an amount so huge that it holds almost unimaginable influence over the rest of the market. It gives these investment firms enough financial clout to control the very gravity of the blockchain. Wall Street doesn't operate like the rest of the investment world. The biggest players in stock markets, equities, and cryptocurrencies don't trade assets back and forth in the same way retail investors do. They buy assets in order to secure them, and then they build wealth from there. When an institution like BlackRock takes control of a crypto coin, it is no longer in open circulation. As the 2026 crash played out, the media spread sensationalized headlines about massive capital flight. They pointed to the $1.4 billion that flowed out of spot ETFs during the peak of the panic. To them, it could only mean one thing: institutional interest in Bitcoin is dead and buried. But when you look at the bigger picture, $1.4 billion is a drop in the ocean as far as these big mega funds are concerned. In reality, the vast majority of institutional capital hasn't moved at all. It is still exactly where it was before the panic began. And while retail investors were getting cold feet and cashing out, the big dogs like BlackRock and Fidelity absorbed the impact. They didn't panic, they didn't flee, because they understood the structural reality of the market. They knew that in holding the line, they could secure the asset's supply and construct an even stronger floor for the future. But with Wall Street hoarding an ever-increasing amount of supply, the actual quantity of Bitcoin left to buy is starting to vanish. One of the most fascinating things about Bitcoin, and one of the factors that has helped it become such a popular asset among investors around the world, is its scarcity. There will only ever be 21 million coins minted in total. That separates it from the very concept of conventional currency in a major way. No central bank will ever be able to just print more BTC. No political decision will ever be able to expand the supply. And the reality is that Bitcoin is even scarcer than it seems, because a huge number of those 21 million coins aren't available to buy and sell, and they never will be. Why? Because many of them are effectively out of circulation. They're stored on lost hard drives, trapped behind encrypted wallets and forgotten passwords, or held in cold storage and untouched for years. A metric called illiquid supply essentially measures the percentage of Bitcoin that's held by entities which show zero propensity to sell. In 2024, that metric reached an all-time high of approximately 78%. That means only 22% of all the Bitcoin ever mined is actually available for open market circulation. It's like trying to buy a home in a major metropolitan city, in which nearly 80% of the homes can't be sold, ever. If a huge part of an asset's inventory is essentially locked away and removed from the ecosystem, even a minor increase in demand can trigger a violent vertical explosion. The value of that asset rockets up. This is the illiquidity shock in a nutshell. It's like a coiled spring being wound tighter and tighter, just waiting to burst into life and expend all the energy it's accumulated. And this brings us to the ultimate, uncomfortable reality about how global markets actually operate. The truth about who really pays for the bull runs. If you ask the average person on the street what drives a major bull market or who has the biggest influence on an asset like Bitcoin, they would probably point to retail investors. They would argue that it's the ordinary people opening accounts, setting up wallets, and putting a few $100s into crypto every month who drive prices higher. They believe that the public has the power. That is a carefully engineered lie. Retail investors don't drive bull markets. In reality, they provide the exit liquidity for the institutions. And to understand that, you have to understand how institutional order books work. A multi-billion-dollar hedge fund or ETF issuer won't log on to their usual cryptocurrency exchange and buy up tens of thousands of coins in one fell swoop. That would have a massive and violent impact on the market. Instead, these mega funds prefer to expand their investments without impacting the market right away. To do that, they have to trigger a wave of sell orders to match their buys. They basically need thousands of individual investors to sell off their positions at the same time and price point. They need people to panic. That's why the June 2026 crash wasn't a random chaotic event. It was planned, programmed. It was an intentional mechanism engineered by the big investment firms to solve their liquidity problem. It's actually quite simple once you know the basics of how it all works. The same algorithms used by market makers can identify areas where large numbers of stop-loss orders are likely clustered. They know the price levels where retail investors have decided to sell to limit further losses. As the market approaches those levels, even a relatively small wave of selling can push prices lower and lower, bringing them closer to that stop-loss zone. Once the first stop-loss orders hit, a chain reaction begins. A wave of additional orders follows, executing automatically. Huge amounts of BTC are sold off without holders even having a moment to think about their decisions. The price drops further and further, still hitting more and more stop-loss limits in the process. Within minutes, the value has plummeted, and to the average investor watching all of this unfold, they get terrified and they start dumping their coins. When BTC's value has dropped about as low as it can go, the Wall Street investors rush in like sharks, snapping up the coins that have flooded the open market. But it doesn't necessarily mean bad news for retail investors. So far, everything about the Bitcoin crash has seemed like it is rigged against the public. It's designed to chew up retail investors and spit them out, with big institutions playing on their emotions and exploiting their panic. That may be true, but it doesn't tell the full story. To see that, you have to look beyond what's happening at the moment. Ignore the headlines because the macro models and projection tools used by some of the world's finest financial analysts are all still pointing in the same direction, up. Their forecasts haven't changed, and nor has their optimism. They still believe Bitcoin is destined to go up, far higher, far sooner than you might expect. Most experts agree that Bitcoin should reach $150,000 to $180,000 by the fourth quarter of 2026. But there is no single agreed view. Different models point in different directions, and they change as conditions change. In moments like this, large price moves are usually tied to shifts in liquidity, leverage, and overall positioning in the market rather than any single clear cause. As those conditions unwind, capital tends to move around the system in ways that aren't always visible in real time. Depending on the perspective, this can look like a normal part of market cycles or like a sign of deeper structural stress. What tends to stay consistent is that those forecasts are constantly being revised as new information comes in. And in markets like this, the story is never really about a single crash or a single rally. It's about cycles, how liquidity enters, how it leaves, and how the structure of the market reshapes itself each time it happens. Because in the end, price doesn't just move in one direction or another. It moves through phases, and every phase eventually becomes the foundation for the next one. As investors scramble to snap up more Bitcoins, one mystery has always remained: the person behind it all. Uncover the truth in who actually created Bitcoin. Or watch this video.